Grab your calculators and dust off your crystal ball. We're diving into the wild world of New Zealand's property market with CoreLogic's number crunching wizard, Kelvin Davidson. By the end of the interview, you might just be able to predict the next property boom. Kelvin Davidson is the Chief Property Economist at CoreLogic NZ, a position he has held since April 2021. With a wealth of experience in economic analysis and property market insights, Davidson has established himself as a leading expert in New Zealand's real estate sector. So over the last 18 months, Kelvin, things have been trending up in terms of property values. What do you think's driving this?
Yeah, it's a mixture of things, really. I mean, I guess more recently, obviously, lower mortgage rates have been a big boost to the market, both in terms of confidence, but also, I guess, direct household finances. People are able to buy and sell property a bit more readily when interest rates are lower. However, going back to the start of that period, interest rates are obviously a bit higher. So I think initially it was about the labour market. People were still in jobs. They were still feeling pretty secure about those jobs. So that sort of started to kick off that upward cycle for sales volumes. Of course, now the labour market's a bit weaker, but then interest rates have kind of stepped in and kept that momentum going. So it's been a mixture of factors, but also I suppose in some ways, a down cycle doesn't last forever. We'd had a period where sales volumes were pretty quiet for 2 or 3 years, so inevitably that was getting at some point, and it's now ended, and we're back on that upwards trend. I guess I'd also just point out though that we're still below normal. Over the last 12 months, we've had sales around about 80,000. So it's up from, I think the trough was around about 65,000. So we have grown quite a bit. That's like 12-month horizons. But normal is something more like 90 or 95. So yes, we've had growth, but we're still below normal. So there's still a bit to go till we get back to, I guess, kind of normality for agents, for anybody deriving revenue from activity.
Yeah. And reading through your recent report, I pulled out a few charts that I think are helpful for people to understand just what's been going on. This first one showing the downturn has been deep and prolonged, and it is very clear from the top of the market, Wellington and Auckland, even Tauranga. These places have had massive drops since the top of the market. And these charts make it quite easy to see, how long does it, do we think until we get back to, the average? Are we on that 10, 20-year average right now? And when are we going to see that peak again?
Yeah, I think so in terms of sales volumes, we're getting back towards normality. As I say, we're probably still kind of 10,000 below normal in terms of an annual sales total. In terms of property values, yeah, I guess there's lots of different ways you could measure normality. And probably when you look at house prices through time, you probably really need to look at house prices relative to incomes, because nominal house prices, of course, do tend to go up over the long run. So where's normal, I guess, is a little bit up for grabs. So I think you need to bring in a sort of benchmark. And I guess house prices relative to incomes is possibly a measure that's important here. Also, things like share of income required to service a mortgage, I think, are ways to assess, I guess, the relative value of the housing market at present. But certainly, we've seen a big downturn, as you alluded to. I mean, values nationally are still sort of 18% below that late 2021 peak. So they've fallen a long way. They're still sort of 16 or 17% above pre-COVID. So, it depends on which benchmark you want to use in terms of where you look at it, good or bad. But yeah, it's certainly been a deep downturn. It's the biggest in recorded history, really. If you go back to GFC, nominal house prices fell about 10% from peak to trough. So the fact we're still at 18% now, kind of 3 years on, is quite a deep downturn and quite prolonged. Some of those markets have been even worse than that. Auckland, Wellington down sort of 20, 25%. So it's, I guess, sort of extra weakness in those areas. I guess one thing that people kind of think about is, well, when do you get back to the previous peak? Now, after the GFC, prices peaked in about 2007, and it was 2012, I think, until that previous peak was regained. So it was kind of a 5-year bathtub, if you like, sort of a downswing, and then the eventual upswing took about 5 years. Now, this time round, I just wonder if it takes a little bit longer. We're already 3 years into the cycle, and we're still 18% below peak. You'd need some fairly strong growth over the next couple of years to get back to that peak within a 5-year period. And I think there's reasons to be sort of relatively cautious about when we go in the next year or two, because yes, interest rates are down, but You've still got jobs being lost at the moment, still a lot of listings out there. DTI's a big change from what we've seen in previous cycles. And I talk about those affordability measures just now. Even though house prices have fallen 18, 20%, some of those affordability measures are still perhaps above average or worse than normal. So that's it doesn't tell you everything about where house prices are headed, but I think affordability measures can certainly tell you a sort of general direction of travel. And the fact that affordability is still pretty stretched suggests that there's reasons to be a bit cautious about growth over the next couple of years.
Yeah, and I was fascinated in your report about just how reliant New Zealand is on residential real estate for the total value of money that we've got. No, it's just fascinating. The residential real estate is $1.62 trillion of value in New Zealand, and you compare that to the KiwiSaver and Super, only 200 billion, listed stocks 174 billion, commercial real estate 333 billion. Like those combined doesn't even get close to being the value of our residential properties. And how does this compare to, say, Australia or other similar economies to ours?
Yeah, you have to scale it, of course, because Australia's got sort of 5 or 6 times our population. But if you do that, and the value of their real estate sector is somewhere around 8 to 9 billion. So it is sort of 5 or 6 times the size of ours. So the ratios do sort of hold. If you look at that real estate wealth per person, if you did that kind of adjustment, the numbers would be pretty similar. And I suspect we haven't done the stats for, I don't know, Canada or the UK, whatever, but yeah, these so-called sort of Anglo-Saxon Western countries do tend to be pretty obsessed with property, and the stats, those kind of headline metrics are pretty similar whether you're in New Zealand or Australia. I suspect if we did the numbers for some of those other countries, we'd see similar results. So, yeah, there's sort of an obsession with property, I guess. I mean, it's been proven to be a long run wealth generator for lots of New Zealanders. I suppose for the economy as a whole, unfortunately, we don't actually really get richer by buying and selling each other's houses. It is a sort of zero sum game at the national level. But for people who do buy property and do see growth in that value, it's because other people are willing to step in and pay those higher prices. So therefore, are sort of servicing a bigger mortgage over time. So there is distributional things going on here, but it has proven to be a pretty successful generator of wealth through time. And yeah, 1.6 trillion of value in the property market at the moment, only on paper, of course, until you sell it. But it is a pretty valuable asset for people, and it has done pretty well.
Yeah, and so the economic indicators somewhat linked to the political landscape globally and domestically. What do you think is having bigger impact, the unemployment rate or the net migration? Like these are things that are going to impact the demand, and both of them are kind of trending against us at the moment. Is that going to put pressure on putting prices to keep dropping, or?
Yeah, I think we're probably at a turning point in the cycle. I mean, it may take a month or two to come through in the data because, of course, there are lags in data. House price indices don't sort of react straight away. It takes a while for it to feed through. You're seeing all sorts of economic indicators that, they're so-called real time, but there is always kind of a month lag or something like that. So it may take a little while to show through in the sort of hard data, but I think we're pretty much at that turning point now. Yeah. Property values have fallen a long
Look,
way. Just detecting, though, that the confidence is starting to return a little bit, and lower mortgage rates are obviously a key driver. We've seen it before. I mean, look at the influence after COVID, where interest rates collapsed down to sort of 2.5%, house prices spiked up, then the reverse has happened since then. So they're still a massive factor for people. But some of those other drivers, yes, net migration not as helpful as it was. I think we saw a lot of the net migration went into the rental sector. So, ultimately, yes, someone had to own that property and buy it, but we saw that sort of hit rental prices more than I think house prices. So in terms of capital values for people, I suspect that the slowdown in net migration may not necessarily be a biggie, but from an investor's perspective, it will determine sort of ease of renting out their properties or the rental return they might get. So there is an impact across the spectrum. I suspect, though, that net migration influence is probably more about rent prices rather than house prices themselves. So that's one to watch. But then on the investment front, I mean, yes, you might not be able to rent out a property as easily, but the mortgage is costing less, that top up is less, interest deductibility is back, buy loan test is shorter, LVRs are looser. So all of these things have sort of tipped the balance a bit. And we are actually seeing investment demand come back. It's perhaps still a little bit below normal in terms of sort of market share, but it is coming back. So I think, yeah, just detecting a sense now that investment property is starting to make more sense again for more people. And that will, I guess, feed into a stronger market this year. But I guess what we've summed up the market is sort of facing conflicting forces. We've got, yes, lower mortgage rates, but then you've got factors kind of holding the market back a little bit as well. So, yeah, sort of I think 2025 will be stronger than 2024, but it's perhaps not the sort of post-COVID style boom either.
Yeah, yeah. Help us understand what's going on with interest only terms. It's quite an obvious trend. There's been change in policy at the banking level, at government. Go back a couple of 10 years, interest only terms over 50% of the lending in New Zealand was on interest only by the looks of it. And now it looks like, below 40% or close to that. So it's quite a big shift that, and I guess that's mostly investors.
Yeah, I mean, interest only, it's an interesting one, isn't it? Because, if you think about the returns to a property investor, how do you generate returns? You get some capital growth, you get some cash flow, and potentially you pay down some debt. Now, of course, if you go interest only, you're not paying down your debt, and you're sort of hoping for that cash flow or some capital gain. Now, recently the cash flow hasn't been that easy either, and there hasn't been much capital gain. So those sources of returns have been sort of pretty limited. So I guess in some senses, people have been able to switch away from interest only and pay some principal. That's been a worthwhile thing to do, especially when mortgage rates have been so low. I guess there's been opportunities to do that, or at least low post COVID. They haven't been so low after that when they spiked back up again. But there was a period there where I guess being able to pay off some principal kind of made a bit of sense, and it might become sensible again in the next few years too. But I suppose internally at the banks as well, I don't sort of have perhaps as much insight into that as maybe you do. But banks perhaps see them from the outside to have been perhaps a little bit more reluctant to extend interest only terms. Yep, you might get it at the start, but keeping it going forever might not be so easy. And I guess just people are a little bit more cautious about that sort of lending. If you can pay off some principal, well, that's great. One thing I guess we've been watching in terms of those interest only lending numbers is just that risk that, I mean, we saw after COVID, of course, where, there was threats of unemployment or that uncertainty that was going on. People switched interest only as a way of saving a bit of money and giving them a bit of buffer. Now, in these last sort of 6 months or so where jobs have been lost, we have been just watching those interest only numbers in terms of possibly starting to see a rise again. If people are feeling insecure about their jobs, they might look to go interest only again just to give them a bit of respite. Well, we're not seeing it. Interest only lending has stayed pretty low. So kind of suggests that yes, even though there's been some job losses, people are still managing. I mean, more generally, we're not seeing mortgagee sales, we're not seeing non-performing loans really spike in banks' books. So yeah, there's some troubles out there, but people are generally coping pretty well, and interest rates coming down, of course, is a big support there too. So yeah, lots of ways you can look at the interest only lending numbers. I suspect, like most things, the real drivers are somewhere in the middle. It's probably a bit of bank policy. It's probably a bit of sort of borrower caution. Those general market factors going on. There's lots of reasons for why we see trends in that, but yeah, at the moment, bottom line is it's lower than it used to be.
So it seems like you're saying that some of this data flow that's coming through now is indicating that market swing, the trend downwards has stopped, and it's anybody's guess of how quickly things will rise. If it will stay flat for a while, so be it, but hopefully drops are over.
Yeah, I think probably, more or less, if you look across the country as a whole, the big downturn that we've had in the past 2 or 3 years does seem to be coming to an end. In our latest house price figures, that there has been some evidence coming through of, I suppose you'd say, provincial markets starting to improve a little bit. So I guess your second-tier cities, Invercargill, New Plymouth, Palmerston North, Napier, that sort of market does seem to be turning around a little bit. Amongst the main centres, there's a bit of resilience there too. Christchurch has held up pretty well throughout all of this. Dunedin hasn't been doing too badly, Hamilton, Taronga. So, those markets are not necessarily picking up, but at least they've stopped falling. There's still some special factors, I guess, going on in Auckland and Wellington, where values still look relatively weak. I mean, Wellington's got its public sector job losses. Auckland's still a lot of stock out there. Listings are still reasonably high. It's still that new build pipeline coming through. So there's always going to be regionally specific factors. You see that in a strong market, you see it in a weak market. Nothing ever moves at the same speed. But I think in general, even though there's some softer patches, Wellington, for example, I think you can start to look to those provincial markets, many of the main centres as well, and see that at least the downturn's ending and conditions might be coming into play for the start of an upturn. Now, of course, just because a downturn ends doesn't mean we're going to see a boom. A post-COVID style sort of 35, 40% increase in property values over 18 months seems pretty unlikely, especially in a world of DTIs, job losses, still a lot of listings out there. So mortgage rates lower, that supports it, but there are restraints as well. So I mean, for what it's, we're not really forecasters as such, but as a guide, I've got in my mind a sort of 5% gain in house prices this year, calendar year as a whole. That's at a national level, but of course, nobody buys the average. Nobody buys a national house, there's no national average dwelling. So, everybody will be around that figure, and some will get 5%, but there's going to be others above that and others below that. And somewhere like Wellington, it could be more like zero or something like that. Flat house prices for a while. Some of those provincial markets could be sort of above that 5% mark. So there's never one housing market, but if that number's any use, sort of 5% across the market as a whole, I think is probably what we're looking at.
Yep, and the fascination continues. So what sort of other anecdotal things do you guys talk about in the lunchroom that doesn't fit into these reports neatly because it's not a factual piece of data, but you do find it interesting?
Yeah, I suppose. I mean, there's always anecdotes swirling around. I suppose a couple of things that we haven't necessarily touched on that they're probably slightly anecdotal, but data based as well. Two things. One is, I guess the lending cliff or the refinancing cliff, if you want to call it that. There's a whole bunch of people on short term mortgage rates at the moment, either floating or fixed, to the point where something like 80% of existing debt right now is either floating or going to see a rate repricing within the next 12 months, and it's something like 50% within the next 6 months. So a lot of people are on short horizons, and so we've seen it's been quite a stampede towards those short horizons. So I guess the theme in the back of my mind is, well, if and when we see that turn the other way this year, at which point do people go, you know what, that 6 month rate isn't so tempting anymore. I'm detecting maybe some inflationary pressure. I'm detecting some longer term rate rises coming through. Maybe I'll jump on that 3 year rate sooner rather than later, or that 5 year rate. Of course, in hindsight, we probably all should have jumped on a 5 year rate in 2021, and hardly anybody did. So, hopefully there's some lessons to be learned there. Not saying we're going to see a repeat of what happened after 2021 in terms of interest rates really spiking higher, but there are probably some lessons to be learned there. So, I don't have a crystal ball. Each person's decision is up to them in terms of what they do. But it is a kind of theme, I guess, I'm watching this year is just that chance that people rush back to those longer term rates sort of sooner rather than later. Certainly one to watch. And then I guess just generally the investment environment, do property investors continue to come back? We've seen a quiet period for quite a while now. People have still been buying rental properties for sure, but it's been tricky to get the sums to work when mortgage rates are 7 and rental yields are 3 or 4. But now the mortgage rates have fallen, that gap's a lot closer. Yes, top ups still required, but top ups are always required. I guess it's just about that scale. And we're probably getting back to a point now where those top ups are more manageable for more people, and property is still a trusted asset class. 1.6 trillion of wealth tied up in there. So I think that's a big theme as how investors go this year, and also just borrowers in general, if and when they switch to those longer rates. Other little anecdotes, I guess a thing we look at, what is the construction sector, of course, because housing supply is going to. Okay, I don't think it matters too much in the short run. In the short run, it's about interest rates, but in the long run, sound like a typical economist here. And in the long run, it's about supply and demand, and so it's about how many houses you need versus how many houses you have. And so construction's a big part of it. We saw a huge flurry of announcements last year from the government around, granny flats and forcing councils to open up land, underwriting developers, easing the planning system, making that smoother. All of these things got announced last year. Could be a bit quieter on that front this year, on that regulatory front. I suppose that's something we've been pondering as maybe it's a year where people just operate within the environment we've got now without having to deal with a whole bunch of new regulation that hasn't happened for a while. It's been a flurry of rule changes. So how people operate in that environment, but in particular how construction firms react, we're just starting to see, I guess, maybe some hints of that bottom being reached in the construction sector. Again, it might not be a massive boom again, but at least the first step is ending the downturn. And then could we start to see more dwelling consents come through this year and perhaps a bit more work for builders? So that's one to watch as well, because of course the more supply we have, I guess that's going to play into a sort of more subdued house price outlook too. So those are some of the things kicking around in my mind. A bit anecdotal, a bit database, but I suppose in terms of themes, that's what I'm watching.
Oh, well, thanks for those comments, Calvin. And there's certainly a lot more information in that report you recently released. And I would encourage people to jump on CoreLogic and subscribe. And some of this lending flow stuff's pretty interesting. And we'll get you back soon. And if you got questions for Calvin or us, leave them in the comments below. And don't forget to subscribe.
Financial